Welcome to Casa Academy Chapter 18, Part 1, where we're going to cover taxes affecting real estate. So we're taking all those earlier concepts we've talked about and finally bringing them together to really dive deep into the nuts and bolts of real property taxes. Let's jump right in. Okay, here's what we've got on the agenda for today. We'll start with an overview of real estate taxes. Then we'll look at ad valorem and exemptions, calculating the tax levy, understanding special assessments, the consequences of unpaid taxes, and finally, a quick summary of tax authorities. Section 1. Overview of real estate taxes. All right, so one of the most absolutely crucial foundational rules you need to memorize right out of the gate is that property taxes are strictly local. I mean, they are never, ever collected by the federal government, and they're not collected by the state government either. Instead, you've got to picture your property taxes going directly to pay for, say, that local fire department down the street, or the public school right around the corner. They're collected by cities, counties, school boards, and other very specific local taxing authorities. Keeping this boundary perfectly clear in your head, man, that is going to save you on so many tricky exam questions later on. Moving right along to Section 2, ad valorem and exemptions. Now, the core concept we need to tackle here is ad valorem. It's a Latin phrase, and if we translate it directly, it literally just means according to value. So when you hear folks say property taxes are calculated on an ad valorem basis, they just mean that the amount of tax you owe is entirely based on the value of that specific piece of property. To figure out that number, the county property appraiser steps in to establish what we call an assessed value. Now, they start by looking at this idea of just value, which is supposed to reflect what the property is genuinely worth in the real world. But here's kind of a fun twist. That assessed value is actually often a good bit lower than the true market value. Why? Well, because the appraiser bakes in certain standard reductions, things like estimated selling expenses. But hey, fortunately for property owners, that assessed value doesn't have to be the final word. Your course materials actually outline a whole variety of property tax exemptions. And these are a huge deal, because they can legally knock down the taxable value of a property, which, you guessed it, significantly lowers the actual amount of tax money you're paying out of pocket. Some of the biggest lifesavers you're going to see on the exam are your standard and additional homestead exemptions, along with some really specific protections designed to help out widows, widowers, and disabled veterans. You'll definitely want to dig into the complete list of these exemptions in your materials because knowing exactly who qualifies for what is a massive part of your day-to-day practice in this industry. Okay, so here is another super important distinction you'll run into in the tax code: the difference between exempt property and immune property. I know they sound incredibly similar, but trust me, they operate completely differently under the law. Exempt property refers specifically to property owned by qualifying churches and nonprofit organizations. So they are subject to taxation in theory, but they're released from actually paying the bill by actively filing for an exemption. Immune property, on the flip side, refers to property owned outright by governmental entities. This property is basically invisible to the tax rolls. It is naturally immune from even being taxed in the very first place. You absolutely have to know this distinction cold for your exam. And while we're on the subject of special tax treatments, we absolutely have to talk about the Greenbelt Law. This is such a fascinating piece of legislation. Basically, Greenbelt provisions provide some highly favorable tax treatment for qualifying agricultural land. Just think about it for a second. As cities expand outward, farmland becomes incredibly valuable to real estate developers, right? Well, if farmers were taxed based on what a developer might pay for their land, they'd be taxed completely out of business overnight. The Greenbelt Law brilliantly steps in to protect this land. It helps preserve agricultural use by assessing the property based strictly on its current agricultural use, and it just completely ignores that potential much higher development value. Section 3. Calculating the tax levy. So how do we actually calculate the final bill? It's really just a straightforward three-step path. Step 1, you start with the property's assessed value, which, like we just talked about, is determined by the county appraiser. Step 2, you subtract any of their hard-earned exemptions, like that homestead or veteran exemption we mentioned earlier. Whatever number is left over, that's your taxable value. And finally, Step 3, you just multiply that taxable value by the applicable local tax rate, and boom, you arrive at your final tax levy. Easy as that. Section 4. Understanding special assessments. And before we get into the details on this, your verification code is 155501. All right, this brings us to special assessments. Now, unlike the ad valorem taxes we were just calculating, special assessments are not based on property value at all, not even a little bit. Instead, these are highly targeted charges, and they're imposed to pay for specific public improvements that directly benefit certain properties in a neighborhood. We're talking about things like neighborhood street paving projects, pouring new sidewalks, or maybe connecting a community to municipal water and sewer lines. And since these charges aren't based on the value of the house, local governments typically allocate the cost to the affected property owners using alternative methods. They might use a flat per lot charge or what's known as a front foot assessment, which basically just measures the exact length of the property line that physically touches the new improvement.
Now, here is a really crucial point to remember, and honestly, this is a classic trap on licensing exams. You've got to think about how streets actually work. They serve properties on both sides, right? So if you get an exam question involving front foot assessments for something like paving a road, you must always remember to account for both sides of the street when you're determining that final cost allocation. If you just calculate it for one side, your math is going to be off by exactly half. Don't let them trick you on that.
Section 5 of Consequences of Unpaid Taxes. So what happens when people don't pay? Well, local governments rely heavily on this tax revenue to fund those essential everyday services like schools, police, and fire departments. They literally cannot afford to wait around indefinitely for unpaid taxes. Because of that, a really strict timeline kicks in. First, the taxes officially become delinquent. Next, the county takes action by selling a tax certificate to an investor for the exact amount of the unpaid taxes. These auctions happen in the spring, and they use this super fascinating reverse interest model. Bidding actually starts at 18% and then goes down, basically rewarding the investor who's willing to accept the lowest interest rate. Then there's a mandatory 2-year holding period. If those taxes still remain unpaid by the property owner after those 2 years, the investor can take the final step, Step 4. That certificate holder can apply for a tax deed. This triggers a whole legal process that can ultimately result in the property being sold at a public tax deed sale, with the proceeds distributed out to satisfy all those outstanding obligations. Section 6. Summary of Tax Authorities. Okay, this matrix right here, this represents arguably the most important takeaway of this entire chapter. You absolutely have to know which taxes belong to which level of government. It's like a giant puzzle. Let's look at the local level. As we've learned today, property taxes and special assessments are local, collected by cities, counties, and school boards. Then, moving up a step to the state level. If you recall from our previous chapters, documentary stamp taxes and intangible taxes are collected by the state. And finally, the federal level. The IRS handles your income taxes and capital gains taxes. Seriously, keeping this categorical breakdown firmly cemented in your mind, that is going to be your absolute superpower come exam day. Mastering this categorical breakdown ensures you are fully prepared to tackle those tricky exam questions and navigate real-world transactions with total confidence. So, as you're reviewing your notes tonight, I want you to ask yourself a question. Do you know exactly which level of government is collecting the taxes in your next transaction? Because at the end of the day, knowing exactly where the money flows is the absolute key to true real estate expertise. Keep studying, and I will see you in the next part of the chapter.